In the realm of investing, simplicity often reigns supreme. Amidst a sea of complex financial instruments and strategies, index funds emerge as a beacon of clarity and common sense. They offer investors a straightforward yet powerful way to participate in the growth of the market without the need for intricate knowledge or constant monitoring. This essay endeavors to demystify index funds and illuminate their virtues as a compelling investment vehicle. By understanding the principles underlying index fund investing, individuals can empower themselves to make informed financial decisions and pave the way for a more secure financial future. Let us embark on this journey of financial enlightenment together. At their core, index funds are like mirrors reflecting the performance of a specific market segment, such as the S&P 500. These funds are designed to replicate the movements of the market, providing investors with a broad exposure to the market's overall performance. By doing so, they offer a straightforward way to invest without the need to constantly monitor and adjust individual stock holdings, or the Dow Jones Industrial Average. These indices are benchmarks that represent the performance of a specific segment of the market. The S&P 500, for instance, includes 500 of the largest companies in the U.S., while the Dow Jones Industrial Average comprises 30 significant industrial stocks. By investing in index funds that track these indices, you gain exposure to a wide array of companies, spreading your risk across multiple sectors. Instead of trying to pick individual stocks, index funds passively track a predetermined basket of securities, representing a particular market index. This passive management style means that the fund's performance will closely follow the index it tracks, providing a reliable and predictable investment outcome. This approach eliminates the need for extensive research and analysis, making it an ideal choice for those who prefer a hands-off investment strategy. Imagine an index fund as a pre-assembled portfolio that instantly grants you ownership in a diversified collection of stocks or bonds. This diversification is crucial because it helps to spread risk. If one stock or bond performs poorly, the impact on your overall portfolio is minimized. This built-in diversification is one of the key benefits of investing in index funds, providing a level of stability and security that can be hard to achieve with individual stock picking. This simplicity is a defining feature of index funds, making them an attractive option for both novice and seasoned investors. For beginners, index funds offer an easy entry point into the world of investing, without the need for extensive knowledge or experience. For experienced investors, they provide a reliable way to achieve steady, long-term growth without the constant need to monitor and adjust their portfolios. By mirroring the market, index funds eliminate the guesswork and emotional pitfalls often associated with stock picking. Emotional investing can lead to poor decisions, such as buying high and selling low, which can significantly impact your returns. Index funds, on the other hand, follow a disciplined approach, sticking to the index they track regardless of market fluctuations. This helps to remove the emotional element from investing, leading to more consistent and reliable returns over time. This passive investment approach allows index funds to operate with minimal costs, which can have a significant impact on your long-term returns. Lower costs mean that more of your money is working for you, rather than being eaten up by fees. Over time, these cost savings can add up, leading to higher overall returns. This is especially important for long-term investors, who can benefit greatly from the compounding effect of lower fees. Unlike actively managed funds that charge hefty fees for their stock-picking endeavors, index funds keep expenses low, ensuring that more of your money stays invested and working for you. Active funds require a team of analysts and managers to research and select stocks, which can be costly. Index funds, on the other hand, simply track an index, requiring less management and therefore incurring lower fees. This cost efficiency is one of the main reasons why index funds have become so popular among investors looking for a simple, effective way to grow their wealth. The financial industry is replete with tales of star fund managers promising market-beating returns. These stories often captivate the imagination of investors, painting a picture of financial wizards who can navigate the complexities of the market with ease and deliver exceptional returns. The allure of such promises is hard to resist, especially when accompanied by impressive past performance and persuasive marketing. However, the reality is far less glamorous. Despite the compelling narratives, the majority of these star fund managers fail to live up to their promises over the long term. The financial news is filled with stories of disappointed investors who have placed their trust in these so-called experts, only to see their investments underperform. Studies have consistently shown that the vast majority of actively managed funds fail to outperform their benchmark indexes over the long term. This underperformance is not just a short-term phenomenon, but a persistent issue that plagues the industry. Numerous academic and industry studies have highlighted this trend, revealing that even the most celebrated fund managers struggle to beat the market consistently. The allure of active management lies in the belief that skilled professionals can consistently identify undervalued stocks and time the market to perfection. This belief is often reinforced by the occasional success stories that make headlines, creating a perception that with the right expertise, market-beating returns are within reach. However, these success stories are the exception rather than the rule. Yet, this pursuit of outperformance often comes at a steep price. Investors are frequently unaware of the hidden costs associated with active management. These costs can significantly erode the potential returns that investors hope to achieve. Actively managed funds typically charge high management fees and incur significant trading costs, which can eat into investor returns. These fees are often justified by the promise of superior performance, but in reality, they can be a substantial drag on the overall returns. The higher the fees, the harder it becomes for the fund to outperform its benchmark. Moreover, the constant buying and selling of stocks by active managers can create a drag on performance, especially after considering taxes on capital gains. Frequent trading can lead to higher tax liabilities, further diminishing the net returns for investors. This tax impact is often overlooked, but can be a significant factor in the overall performance of an investment. The evidence suggests that for most investors, attempting to beat the market is a futile and costly endeavor. Instead of chasing the elusive promise of outperformance, investors might be better served by focusing on low-cost, passive investment strategies that aim to match market returns. By minimizing fees and reducing the impact of taxes, these strategies can provide a more reliable path to achieving long-term financial goals. The dream of market-beating returns may be enticing, but the reality is that for most investors, it remains just that, a costly illusion. The power of diversification. Mitigating risk through broad market exposure. Diversification is a strategy that can significantly enhance the stability and performance of your investment portfolio. One of the fundamental tenets of sound investing is diversification, the practice of spreading your investments across a variety of assets to reduce risk. By not putting all your eggs in one basket, you can protect yourself from the volatility of individual investments. This means that if one investment performs poorly, the others can help cushion the blow, balancing out the overall performance of your portfolio. Index funds excel in this regard, offering instant diversification by holding a basket of securities representing a particular market segment. These funds are designed to track the performance of a specific index, such as the S&P 500 or the NASDAQ, providing broad exposure to a wide range of companies and industries. This built-in diversification can help reduce the risk associated with investing in individual stocks. By investing in an S&P 500 index fund, for instance, you gain exposure to 500 of the largest publicly traded U.S. companies across various sectors. This means you are not overly reliant on the performance of any single company or industry. Instead, you benefit from the collective performance of a diverse group of companies, which can help smooth out the ups and downs of the market. This broad market exposure helps mitigate the impact of any single stock's performance on your overall portfolio. When you diversify, you are essentially spreading your risk across multiple investments, which can help protect your portfolio from significant losses. This is especially important in times of market volatility, when individual stocks can experience sharp declines. Diversification is like an insurance policy for your portfolio, cushioning it against market volatility and reducing the likelihood of significant losses. By holding a mix of different investments, you can reduce the impact of any one investment's poor performance on your overall portfolio. This can help you achieve more consistent returns over time and reduce the stress and anxiety that can come with investing. Index funds make diversification accessible to all investors, regardless of their portfolio size or investment expertise. These funds are typically low cost and easy to invest in, making them an attractive option for both novice and experienced investors. By providing broad market exposure, index funds can help you build a well-diversified portfolio that is better equipped to weather the ups and downs of the market. Whether you are just starting out or looking to enhance your existing portfolio, index funds can be a valuable tool in your investment strategy. The compounding effect time. the investor's greatest ally. In the world of investing, time is your greatest ally, and the compounding effect is its most potent weapon. Compounding refers to the phenomenon of earning returns on your initial investment as well as on any accumulated earnings. Imagine a snowball rolling down a hill, gathering more snow and momentum as it descends. Similarly, your investments grow exponentially over time as your earnings generate more earnings, creating a virtuous cycle of wealth accumulation. Index funds, with their low costs and consistent performance, allow you to harness the full potential of compounding. By keeping expenses to a minimum, index funds ensure that more of your money stays invested, working tirelessly to generate returns upon returns. Index funds versus actively managed funds, a performance comparison. The debate between index funds and actively managed funds has raged for decades. However, the evidence overwhelmingly favors index funds, particularly over the long term. Numerous studies have demonstrated that index funds consistently outperform the vast majority of actively managed funds. This superior performance can be attributed to several factors, including lower costs, broader diversification, and a disciplined investment approach. Actively managed funds, on the other hand, often struggle to overcome the drag of high fees and the inherent difficulty of consistently outsmarting the market. While there may be short periods when actively managed funds outperform, these instances are often fleeting and unpredictable. Over the long haul, index funds have proven to be a more reliable and cost-effective way to build wealth in the market.